All right, welcome everyone. I see attendees joining us today. We'll give it just a few moments for everyone to file in. Welcome to our W&A Webinar Wednesdays. All right. Sean, we'll go ahead and get started. Again, we'll go a little bit slow, give everyone time to join us. Thank you, as I said before, for joining us today for one of our Webinar Wednesdays. You'll see emails from us. If you don't receive our emails and someone forwarded you this invitation, please text Cash Play, again, one word, Cash Play, to 44222 using your cell phone. You enter 44222 just like you would a phone number and text the word Cash Play to opt into our email list. We'll have that up again at the end of our webinar. Today's webinar is one of my favorite subjects, making money. It takes money to make money, strategic plays for cash. So we're so happy to have Sean Gould, one of our senior wealth strategists, joining us today. And I'm especially grateful, as busy as Sean is. He's one of the most efficient, diligent workers I've ever met in my entire life. He's always doing something. He took time out of his week with just a little over a week's notice because I said, Sean, what if I had a big pile of cash? Take me to school on what I would do right now with that big pile of cash. So Sean, I'm not going to take up any more time introducing you. Let's jump right in. What do we do with our cash right now?
Well, good afternoon, everybody. Thanks for joining us. I'm Sean Gould, Senior Wealth Strategist at Waddell & Associates. I hope everybody is safe and well. As Teresa mentioned, we are getting this question a lot right now. What do we do with cash in this uncertain environment? Cash presents a great opportunity for investors. Maybe you sold a business, maybe you sold a piece of real estate. Maybe you've built up cash through diligent savings. Maybe you've sold out of the market and you're thinking about re-entering. If you're sitting there and you're in this circumstance and thinking, what do I do? Things are uncertain. Well, today I want to go through our recommendations and our thoughts on this exact subject.
And Sean, real quick, one thing I forgot to mention in the intro is we do have a Q&A chat.
Absolutely.
Your question, I'll see that. We probably won't take them going along the way. I don't want to interrupt Sean's presentation and my learning, but at the end, we'll definitely have time for some questions. If we don't get to all of them, we'll follow up with each of you one-on-one, make sure those questions get answered.
Great. Thinking about cash, cash can be used to shape your overall asset allocation called for by your specific strategic financial strategy. If you don't have a strategy in place, you need one. At this point, when we're sitting in periods of uncertainty, it really stresses the importance of, again, having a strategy in place. If you don't have the experience to craft one by yourself, I recommend, again, finding a trusted advisor that can help, navigate these uncertain periods of time. Things are moving very fast. It's important to have a strategy in place. First, thinking about cash, you need to have an emergency reserve. We recommend having 3 to 6 months spending in a liquid, accessible savings account, cash. During periods of uncertainty, like a pandemic, you might lose, you or your spouse might lose your job. You might have a serious cut in your pay. Having that 3 to 6 months spending available is vital. So thinking about cash over and above that, that's when we start thinking about how much and how to invest that cash. So here are our disclosures. If you want to read them real quick. Thinking about taking a step back and, certain individuals might have an upcoming need for cash. Maybe it's a tax liability, taxability. Maybe you're putting a big down payment on a real estate property or home. If you need cash for the short term, just to give an idea what current rates are, you can see taxable money market funds, which are not FDIC insured, paying just a little over 40 basis points, so 0.4, a little over 0.4% a year. 6-month CD rates, again, you have illiquidity there, paying close to 0.20%. 3-month T-bills, paying again close to nothing at this point, around 0.11%. Treasury money market funds, which are backed by the full faith and credit of the government, paying essentially nothing. So what we do have at W&A, because of our relationship with Focus Financial, we do have a client portfolio cash program. As a reminder for everyone about FDIC insurance, that's to protect depositors at banks. If the bank were to fail, you have $250,000 worth of protection per depositor per bank. Well, if you have a cash amount need over that amount and you don't want to have to go source it at different banks, our solution provides a one deposit solution. We take the burden from you to go source the different banks. So you have one account yielding around 0.25%, and it offers up to $50 million worth of FDIC coverage. It's daily liquid. You can use it for individual accounts, corporate accounts, trusts, IRAs. So if you do have that need, let us know. We can absolutely help you. So looking at our strategic case for stocks. So what to do with cash right now in this uncertain environment. So looking back, going to the early 90s, this is showing what income was earned on $100,000 in a savings account. So orienting you, going back to the 90s, you can see $100,000 in cash was paying close to $4,000, all the way up to $6,000. So you were earning 4 to 6% on your cash holdings. What that line across the page and chart is showing is inflation, how much the cost of goods are going up every year. So what I want to point out here is as you go across the years, you can see on the bottom axis, as we get into the financial crisis, the Fed dropped interest rates next to nothing to spur economic activity to get us out of the recession, and it worked. Unfortunately, what you're getting paid on your savings account has not come back. It's sitting next to nothing. So you can see the cost of holding that cash is it's actually a diminishing asset. Inflation is beating what you're getting on a typical savings account. Right now, sitting in cash, it's again a diminishing asset. It feels good, but you're actually paying 2% a year just to hold that cash. So it's costing you something. So
Sean, this is like it takes money to not make money right now.
That's exactly right. That's exactly right. So just to see the cost of carry for cash right now, looking at the next asset level from a risk perspective, comparing stocks to bonds, what this chart does, we're going back to the 70s and we're looking at the 52-week forward earnings on the S&P 500, and we're comparing that to investment grade bonds. And the takeaway here is if you look at the bottom right, what this is showing is that stock values compared to bonds, stocks are significantly undervalued comparing that to bond yields. We're in a very low interest rate environment, and you're thinking of the opportunity for cash and the, between stocks and bonds. Stock yields are a lot more attractive right now compared to bonds. Looking back over the last decade, this is the cheapest, the most undervalued stocks have been compared to bonds in a number of years. So again, stocks right now, much more attractive than bonds. Bonds do have a place in a portfolio allocation to help for volatility, but stocks right now are more attractive than bonds. So looking here, I wanted to show what the S&P 500 right now is paying in dividends. So we're going back to the 90s, and what this is showing is the significant increase in S&P 500 companies paying a dividend. You can see that number now, as you work across a decade, you're seeing close to 78% of the S&P 500 paying a dividend. Right now, the average dividend yield on the S&P 500, it's around 2%. Historical is closer to 4, but again, in this lower interest rate environment. So when you're competing for yield, you're getting yield and earnings growth potential out of the market right now. And you think of the 78% stocks that are paying a dividend in the S&P 500, 93% of those have a yield higher than the 10-year treasury, which is 0.70%. So there's a case to be had thinking about markets and thinking about stock markets of not only earnings growth potential, but yield. People don't think about the yield potential within the market often. So, another very attractive point to the stock market. What we're looking at here, I wanted to add to some perspective. This is looking at 30% drawdowns and recoveries going back to World War I. So if you'll notice, the red dot on each chart, so this is each 30% drawdown in the Dow. Each point shows, again, the 30%, and then along the bottom axis is how many days in the recovery. If you focus on the bottom right, that's where we are now. So we've had the quickest 30% drawdown in market history. It only took 22 days for the market to fall by 30% and more. But if you look at all of these different periods, what I want you to notice is look at the earnings years out after you've reached this 30% pullback. At W&A, we deal in probabilities, not possibilities. I can't guarantee, that where we are now is going to look like this, but historically speaking, it's a good time, again, for stocks right now with looking at what the markets have done when we've seen periods like this in the past. Now, we have had a significant drawdown, and we had a solid recovery coming out of April. With the CARES Act, with the amount of stimulus the Fed and Congress provided, we had a very quick pop back. And some of you might be thinking, did I miss the boat? What's the situation now? So looking at market returns for 2020, where do we stand now? I'm going to first start on the left. This is the S&P 500. So this is your large cap stocks within the U.S. The S&P is down 10%. This doesn't include today's market activity. We had a little bit of a down draw today, but the S&P is down 10%. The fallacy with the S&P, it is a cap-weighted index. So Amazon, Apple, Facebook, Google, Microsoft, those 5 names make up 20% of the index. So, it's important to look at, if you peel the wrapper and look at an equal weight. So if you were to equal weight the performance of each stock within the S&P 500, that is actually down over 18% on the year. So there's still opportunity to be had during this drawdown. I included the ACWI, the MSCI ACWI, that is the globe. So that's the US, that's international stocks. That index is down over 14%. And then the Russell 2000 is small cap stocks, small company stocks. That index is down close to 23% on the year. So we've had a historic drawdown. We've had a historic pop back, but if you're sitting in cash, there's still great opportunity to be had in the markets right now.
So Sean, what I think I heard is number one, there's still opportunity. We're still down, but I also, it's okay to pause and ask you about right now.
Yeah.
What about specific stocks versus, a collection like you've shown here?
Great question. The issue with single stocks at this point is we're in very uncharted waters. There's a lot of uncertainty around specific names. If you do want to play a specific stock, I would keep it well below, 5% of your overall portfolio. As you can see in this chart, different types of stocks are going to perform different during different periods of time. We recommend having a diversified portfolio across cap size, across geography, across sector. So, again, over time, having a diversified portfolio, in our view, makes sense. So, looking at historical market returns, where we stand now, again, thinking about what to expect going forward, I wanted to show what the typical average stock market return looked like after severe drawdowns. So typically you get, on average, around 9.5% a year out of stocks. So, as we know, there's volatility, so it's all over the map. But on average, you're getting around 9.5%. What this shows, I'm showing you market returns after a 10% decline and after a 20% decline. I want you to focus on looking at the 20% decline now. You can see I have the 1-year average, the 3-year average, and the 5-year average. So you can see, on average, after 1 year, after a 20% decline, you're getting over 14% out of stocks. And then if you extrapolate that out, 3, you're getting almost 12% a year out of stocks. And then on a 5-year average, you're still getting above that historical average. So again, this just speaks to, it is a great entry point, statistically. Can't guarantee future returns, but this is, after the volatility we've seen, going back in history, this is statistically a good time when you're looking at possible future earnings. So this is a great chart. This looks at historical returns by year. So your annual market returns. What did the year do in the market? So if you look starting on the far right, these are years when the market returned over 20%. And then looking one bar left of that, this is years when the market returned 10 to 20%. You can see also on top of those charts, I have the percentages of time the market is hitting. So for example, over 20%, that's 37% of the time you're getting over 20%. People think of the market as a bell curve. You have good, you have bad, but it's actually dramatically skewed to the right. The majority of years are in those good market years. What I want to point out is if you look at, I've circled 2008 for you. We know that was a huge drawdown year. We're in this same period now. We've had a big drawdown. So if you look back at that period, looking at the future years, what happened after that? Here's 2009, which is in that greater than 20% bucket. Here's 2010 in that 10 to 20%. Here's 2011. Here's 2012. Here's 2013. So the theme here is after a painful period in the market, statistically, there's a lot of good years coming up. So, that just speaks to having cash now. Again, could be a great time to enter the market.
Sean, I think this one speaks specifically to, I know we're talking a little bit about trying to time the market, just cash being, this being a good point, but this is maybe the time in the market slide.
That's exactly right.
That's a very compelling slide.
Mm-hmm. So getting in at an entry point now to experience those great years after periods of volatility. So one metric we look at, it's the AAII, the American Association of Individual Investors. This chart shows, it's very interesting, going back 30 years and showing the 1-month change in investors' allocation to cash. So if you look at the top right, you can see March 2020, we had a huge increase of investors increasing their cash allocations. The highest 1-month change we've seen since going back to the financial crisis, which you would expect during huge periods of uncertainty, investors having that flight to cash. And the reason I point that out is what we're looking at here. This is looking at investors' allocations going back to 1990. And the green is stock allocation and the blue being cash. Okay. So if you go back, you can see during the dot-com bubble, during 9/11, you had massive drawdown in the market. So that brought stock allocations down. And then you had massive amounts of people selling, going to cash. So I have the line drawn there because I want to show you when stock allocations come down to 55% on average for investors, what can you expect going forward? So it's hard to see because it was such a quick drawdown during March, but we're at that 55% stock level now. So we've reached that point. So if you look at S&P earnings going forward, I want to highlight for you the periods going back since 1990. I've circled the first one there when that stock allocation came down to 55%. Looking at future possible earnings, it speaks to, again, can't guarantee, but it speaks to, possibly a good entry point into the market, showing that over history, you've had really good market returns when that indicator gets down to the average investor having 55% stocks. So the next question, people are asking us, how would you manage the cash? What would you do with it? We would recommend, if you called me today and say, hey, I have a check, we would put a large portion to work now because, again, just as I had reviewed, we've had a lot of downside, a lot of volatility. So with this drawdown, there's been great opportunity. So we'd sink a portion of the market today. And then we would actually dollar cost average, which means we would invest that same amount, every few weeks over the next several months to avoid that bad timing scenario. You don't want to sink the money in that first minute and then have more volatility. So we'd put a portion in and then dollar cost average over the next several months. And what this chart is showing, it's a great visual. So this is going back to 2007, right before the financial crisis. And if you put $100 in the market every month, what is that ending value today? So if you put $100 in all the way to 2020, what is the value of that $100 today? So you can think of this as being essentially an upside down stock market, upside down returns, because you can see working up through the financial crisis, the value of that $100 is exponentially higher because you're buying low. So over time, buying at a period like we're seeing right now during a drawdown, you're experiencing more growth going forward. Another point to make on this is, people get paralysis. They think, okay, I want to time it perfectly. The beauty is you don't have to time it perfectly. We've seen a drawdown, and you can see going back to 2007 into 2010, you made money regardless. So participating, working money into the market during these drawdowns, pays off.
So Sean, just to make sure I understand, on this chart, if we were to lay the returns of the market on top of this chart, it's opposite of what you're seeing.
That's exactly right. So this is
here
showing,
you have a drop.
Correct. So when the market drops during the financial crisis, this shows how much the benefit of buying in on that dip. You can see how much more that investment's worth now because you bought on a dip. Which again speaks to the benefit of buying during a drawdown like we're going through right now. So we talked about, what to do with cash, how would you invest the cash, what would you do with it? Now I want to talk about some actual strategic plays with cash, specific accounts. So starting with HSAs, these are health savings accounts. Think of this as a health 401k. So it's a triple tax advantaged account. You can have them, sometimes you'll have them through your employer if they're offered. You can also open them individually on your own. And if you're in a high deductible healthcare plan, so I have the data laid out. So if you're a family, if your minimum healthcare deductible is $2,700, you can put in $7,000 a year. If you're over 55, you can put in another 1,000. And I wanted to, I listed the facts for 2019 because with the CARES Act, you can actually contribute to 2019 up until July 15th of this year. So you could actually put in 2019 and 2020. These accounts roll year to year, so you can actually invest these accounts and allow them to grow. And again, it's a triple tax advantaged account, which are unusual. They're fantastic. You get a tax deduction for your contribution. You get tax deferred growth. So you're not paying tax on your dividends and your capital gains. And then when you draw the money out for a qualified expense, it's tax free. So these are great savings tools to not only put in money now, if you have cash, but to put in money going forward within your plan.
Sean, I have to jump in right here. I don't know if the viewers could see it, but because you're also a CPA, your face just lit up when you were full tax advantage. But I did want to go back to the rolling over part.
Yes.
Just to clarify, sometimes I think these get confused with the FSA accounts. So can you explain a little bit more about the difference between an FSA and an HSA?
Can, absolutely.
And
So
HSA is a longer term plan.
That's right. So HSAs, they roll year to year. So FSAs, if you don't use the money, it's a use it or lose it. Or, well, HSAs, health savings accounts, you can put money in, you can invest it and allow it to grow for years. That's a great question.
Thanks.
Another strategy with cash is doing Roth IRA contributions. So this is after-tax money that goes into an IRA. It grows tax deferred. And then money that you pull out is tax-free after age 59 and a half, penalty-free as well. So you get tax deferred growth, tax-free withdrawals. And thinking through the limits, there is an income limit on Roth IRAs. If you're single, if you make over 122,000, there's a phase out up into 137. And then if you're married, your income limit is 193,000 up to 203,000. The contribution limits, again, I have 2019 listed because you still can contribute to a Roth, are $6,000 per individual based on if you have earned income. So a married couple, even if only one spouse works, if you have earned income over 12,000, you can put 12,000 into a Roth IRA. And if you're over 50, you can put another catch-up contribution as well. And if you do make over that income amount, there are strategies to get around that. There's backdoor Roth IRA contributions. So there are ways to get money in that Roth bucket, even if your income's over that amount. So that's another great strategy. I wanted to show the impacts because it might seem like a small amount to start. But if you were to do the $12,000 a year as a couple into Roth IRAs, and then also start building your HSA balance and investing these accounts, if you get an average of 7% annual investment return, you can see the impact looking at the accounts going 10, 15, 20 years out. That's a material impact, and looking at close to over $845,000 with growth on those two accounts. So it's a great way to build out your tax diversification on your balance sheet. Another strategy.
Oh, Sean, I was just going to say, so for this one, it's maybe I don't have one big bucket of money right now. Mm-hmm. Maybe I have, an extra, $20,000 every year, and I'm not quite sure what to do with it.
That's right. So it's a great tool to put money in starting now and going forward. It's a great tax diversifier. Another great tool are 529 accounts. These are education accounts that you can set up, and the money goes in. It's tax-free growth. If the money comes out for qualified education expenses, it's tax-free as well. And you can put in an amount every year. But what I'm going to think about recommending right now, because we've had this drawdown in the market, you can actually front load a 529 and put in $75,000 each spouse per child. So you can put in up to $150,000 per child into a 529 for a 5-year period. So you couldn't contribute again for another 5 years. But that's a great way if you're in cash and you want to save money for education for children, grandchildren. That's a great strategic way, tax efficient way to save for education.
Sean, that's an awesome point. Definitely let me know how those conversations go, since all the parents have been stuck at home with their children for a couple months now.
That's right.
They might feel more inclined to gift, but perhaps we do have a couple questions if we're at Q&A time. Again, you still have time to get them in. If we don't get to them by the end of this, we have just a few more minutes left, and we'll reach out individually. Sean, I have one here about how do we use cash to pay down debt, and should we?
It's a great question. So going back to the interest rate slides and demonstrations I showed, with interest rates coming down, so I'm thinking like a mortgage, your mortgage debt. We're in a historically low interest rate environment. I would recommend keeping that debt. Your mortgages, you're getting, not only a mortgage interest deduction, but right now mortgage rates are between 3% and 4%. It actually makes sense if you're going to be in the house for, call it at least 3 to 5 more years. If you're paying well over 4%, it might make sense to refinance right now. Car notes, same thing. Again, debt is cheap right now. When you think of the cost to carry, expected returns are higher going forward than what the cost of debt is. Now, if you have credit card debt, maybe student loans, anything over that, 8 to 9% range, getting into the double digits, then that's the debt you want to pay off immediately. That's what I would recommend.
So you need to compare the cost to the opportunity lost that you'd have.
Exactly right.
Okay. Another question, Sean, how would you approach real estate opportunities right now using cash?
Yeah. Real estate right now, we are in an uncertain period. I would recommend having a real estate professional to work with. We have plenty of recommendations here at WNA if you need one, but that really is specific to, the specific real estate, whether it's, if you're looking to buy a home with rates being, again, low right now, it probably is a good time to buy, a home. Other real estate investments, there is some uncertainty. So I would say that's specific to, each specific case, but definitely have a professional involved in real estate. Again, looking at overall asset allocations, there is a place for real estate in portfolios, but right now in this uncertain time, I'd be careful there.
Yeah, I heard you say uncertain a few times. I think real estate and this pandemic, uncertainty is definitely there. And back to my joke about children being a little close. This one is interesting. What do you think about using cash for family gifts and charities?
Yeah, I mean, now is I mentioned the 529s. If you're wanting to gift to children, grandchildren, 529s are great tools. You can gift up to $30,000 a year and avoid any type of gift tax issues. You can set up custodial accounts for children. It is important, again, to have a full estate plan updated in place for circumstances like that. If something were to happen, you want your child or grandchild to have, a guardianship over those accounts. You can also do strategies, like an annual exclusion trusts. So yeah, there are great strategies to gift right now.
And then, here's a fun one, and this will be our last one. How do you feel about prepaying bucket list travel destinations, like right now with what's going on right now?
This one hits close to home.
That's right.
That's
Sure
right.
does.
I have a trip that I've had to cancel, and what I would advise, there are a lot of deals to be had right now. Again, with the uncertainty going forward in the travel space, hotels, airlines, they're begging for customers. What I would recommend is, you can find deals right now, and if you're comfortable booking something, several months out, I would recommend getting travel insurance. So if you do have to reschedule, you get your money back. But yeah, if you have a destination in mind and you have some cash and want to put down on a trip, there are deals to be had, but I would absolutely recommend getting travel insurance to make sure you don't lose the money if something were to happen several months out.
So yes, but a cautious yes.
Yes.
Great. Thank you so much, Sean, for running through that.
Absolutely.
As you said, so much uncertainty right now. And if you find yourself with a modest amount of cash or a giant bucket of cash, I think Sean's done a great job showing that working with a wealth strategist to help you come up with a strategy is especially important during times like this. If you want to join our mailing list, again, you get a replay of this and also our weekly strategic insight. You can text using your cell phone to 44222, just like it's a phone number, the word cash play. You can also visit our website at www.waddellandassociates.com. We have a COVID-19 portal where we've been updating many of these webinars and other information about the current environment right now. Thank you so much for attending, and everyone stay safe, and until next Wednesday.